JPMorgan just disclosed a $7 billion position in silver derivatives. This isn't a normal portfolio allocation. This is the same institution that paid $920 million in fines for manipulating precious metals markets. The same bank that admitted to spoofing silver prices for nearly a decade. And now they've built the largest silver derivatives position in their recent regulatory history. The filing came through last week. Most investors missed it completely. But this position tells us something critical about what's coming in the next 12 months. When the largest commodity trading bank in the United States moves $7 billion into a single metal, they see something retail investors don't. They have access to data you'll never see. Warehouse inventories, industrial order flow, settlement pressures. So what do they know? And what does this mean for anyone trying to preserve wealth right now? If you want serious analysis of precious metals markets without the hype, subscribe now. We focus on market structure and institutional positioning. No conspiracy theories, just data. Let's continue. Let's start with what actually happened. Every quarter, institutional investment managers file a document called a 13F with the Securities and Exchange Commission. This disclosure shows their positions in publicly traded securities and certain derivatives. It's mandatory, it's public, and it's delayed by 45 days. JPMorgan's latest 13F showed $7 billion in silver derivative exposure. To put that in context, their previous quarter showed roughly half that amount. They doubled down. And they did it while most retail investors were watching tech stocks and cryptocurrency. Now, JPMorgan has a complicated history with silver. In 2020, they admitted to spoofing precious metals markets. That means they placed orders they intended to cancel to manipulate prices. They paid $920 million in fines. Their traders went to prison. This wasn't a gray area. This was fraud. But here's what matters now. JPMorgan didn't exit silver markets after those fines. They stayed active. They're one of the largest clearing members on the COMEX futures exchange. They handle physical delivery. They operate vaults. They see order flow that retail investors never access. So when they build a $7 billion derivatives position, it's not speculation. It's strategic positioning based on information advantages. The timing matters enormously. COMEX registered silver inventories are near multi-year lows. Registered means available for delivery against futures contracts. When registered inventories fall, delivery risk rises. The exchange has enough silver to settle current contracts, but barely. And open interest remains elevated. Industrial demand is accelerating simultaneously. Solar panel production uses approximately 100 million ounces of silver annual, while AI's end is growing. Electric vehicles use up to 1 ounce of silver per car. Data centers. 5G infrastructure. These aren't discretionary uses. You cannot substitute silver in most applications. Companies must secure supply. This creates a gap. Paper silver contracts trade freely. Physical silver becomes constrained. That gap is widening right now. JPMorgan's derivatives position isn't a bet on silver going up. It's positioning for a structural repricing. When you understand derivatives, you know these instruments provide leverage and strategic exposure. They allow institutions to control large positions with less capital. They provide optionality. But here's the critical piece most people miss. The 13F filing has a 45-day delay. That means JPMorgan built this position 6 to 16 weeks ago. They were buying while the market was quiet. They accumulated before any headlines, before any retail awareness. You're learning about this position after it's complete, after they've positioned, after they've secured their exposure at prices that no longer exist. Why would they do this now? What changed in the silver market between August and November that made them double their position? What data did they see? What supply constraints did they identify? What industrial demand forecasts crossed their commodity desk? These aren't rhetorical questions. These are the questions that should drive your analysis. Because JPMorgan doesn't build $7 billion positions on hunches. They build them on proprietary data, warehouse reports, industrial order flow, and structural analysis. And they did it quietly. No press releases, no announcements, just a regulatory filing after the fact. Most retail investors still think silver is just a precious metal. They see it as gold's cheaper cousin. They don't understand it's the most industrially critical metal facing the largest supply-demand imbalance. They don't realize that 90% of silver futures contracts settle in cash, not metal. They don't know that COMEX warehouses are running lean while industrial consumption accelerates. JPMorgan knows all of this. They see it in real time. And they just committed $7 billion based on what they see coming. But here's what most people don't understand about how this actually works. The system that prices silver is not what you think. Let me show you exactly how this structure breaks. Silver prices are discovered on the COMEX Futures Exchange in New York. This is paper trading. Contracts that represent silver, not actual metal. Most of these contracts never result in physical delivery. Traders settle in cash. They take profits or losses in dollars and never touch an ounce. This system works when everyone agrees to play along. when buyers accept cash settlement instead of demanding metal, when the exchange has enough registered inventory to cover the small percentage that demands delivery. But the system has a fatal flaw. It allows unlimited paper claims on a limited physical metal. Think about it like a bank. A bank doesn't keep every depositor's money in the vault. This works until everyone shows up demanding cash at once. Silver markets operate the same way. Thousands of paper contracts exist for every ounce of registered physical metal. This creates price discovery, sure. It creates liquidity. But it also creates systemic fragility. Institutions understand this better than retail investors. JPMorgan, as a clearing member, sees the actual inventory levels. They see the delivery notices. They know which accounts are holding physical and which are holding paper claims. They access warehouse reports before they're public. They see industrial buyers scrambling to secure supply. When you know the warehouse has 10 million ounces of registered silver and you see 15 million ounces worth of delivery notices coming, you understand what happens next. Prices must rise until enough contract holders accept cash settlement instead of demanding metal. Current market stress signals are everywhere if you know where to look. COMEX registered inventories dropped from 350 million ounces in 2020 to under 120 million ounces today. That's a 65% decline. Meanwhile, open interest stayed elevated. More claims on less metal, physical premiums, are rising across retail and wholesale markets. When you buy a silver eagle from a dealer, you pay a premium over spot price. That premium reflects actual supply and demand for physical metal. Those premiums are widening. Dealers are paying more to secure inventory. Delivery times are extending. Industrial demand is accelerating faster than most investors realize. A utility-scale solar farm uses approximately 3 million ounces of silver. Electric vehicles average 0.8 ounces per vehicle. As production scales, consumption scales. These industries cannot wait for price discovery. They must secure supplies to maintain production schedules. Silver has no substitute in most applications. You can't replace silver in EV contacts and maintain reliability. Companies either secure silver or they halt production. This creates inelastic demand. When industrial buyers need metal, they don't trade futures contracts. They buy physical or secure allocated positions. This removes metal from the available supply. But the futures market keeps trading as if that supply still exists. This gap cannot last indefinitely. History shows what happens when it closes. In 2011, silver spiked from $30 to nearly $50 in weeks. In 2020, premiums exploded and dealers stopped taking orders. Physical markets seized while paper markets kept trading. The system depends on most traders accepting cash settlement. When that assumption breaks, when enough participants demand physical delivery, prices must adjust to clear the market, not through gentle rebalancing, through violent repricing. JPMorgan sees this structure. They understand the gap between paper claims and physical reality. They know the registered inventory numbers. They see the industrial demand forecasts. And they positioned with $7 billion before the gap became obvious to everyone else. This isn't about JPMorgan being smarter than other investors. It's about access to information. They see order flow. They see warehouse activity. They see which accounts are converting paper to physical. They see industrial buyers increasing allocations. They see the mechanics of a market under stress, and they positioned accordingly, not after the headlines, not after retail investors panic. Before. Quietly. Strategically. This is how institutional investors operate. They identify structural imbalances before they're obvious. They position before prices move. They use information advantages that retail investors don't access. The $7 billion position tells you they see this gap closing. They see physical asserting over paper. They see a repricing coming. So if JPMorgan sees this gap, if they're positioned with $7 billion, what does that mean for anyone holding cash or trying to preserve wealth right now? When JPMorgan takes a $7 billion position in anything, other institutions notice. Commodity markets aren't like stock markets. Silver is thin. Total annual mine production is roughly 850 million ounces. A $7 billion position at current prices represents a significant percentage of the annual supply. Other banks see these filings. They run their own analysis. They check their own data. If they reach similar conclusions, they position similarly. This creates momentum in a market that doesn't have deep liquidity. Silver moves faster than gold. The market is smaller. Price swings are larger. Now think about how you access silver. Most investors who want silver exposure buy ETFs. SLV is the largest silver ETF, but understanding what you actually own matters enormously. Some ETFs hold allocated metal. Each share represents specific bars in specific vaults. Other ETFs hold unallocated positions. You own a claim on silver, not a specific metal. During supply stress, that distinction becomes critical. Allocated positions give you rights to physical metal. Unallocated positions give you exposure to silver prices. If the gap between paper and physical widens, allocated positions maintain value. Unallocated positions face settlement risk. This is why institutions buy allocated metal. They understand counterparty risk. They understand the difference between price exposure and physical ownership. When JPMorgan positions in derivatives, they're using sophisticated instruments with specific settlement terms. They're not buying unallocated pool positions. Timing matters here more than most investors realize. When you recognize a structural opportunity after institutions have positioned themselves, access changes. If you wait for confirmation, you wait for headlines. Headlines come after price moves, after premiums spike, after dealers allocate limited inventory to preferred customers. During the 2020 silver squeeze, retail investors couldn't buy physical at any reasonable premium. Dealers were weeks behind on orders. Premiums hit $12 over spot for basic products. Some products became completely unavailable. Buyers with cash couldn't access metal. That's what happens when everyone recognizes the same opportunity simultaneously. The market can't absorb sudden demand for physical delivery. Prices gap up. Access becomes constrained. People who position early get filled. People who wait get allocated or shut out entirely. A JP Morgan's position isn't a prediction that silver hits $50 next month. It's a structural view that the gap between paper and physical cannot persist. The view is based on data that retail investors don't see. Warehouse inventories, industrial demand forecasts, delivery pressures, settlement flows. When that gap closes, it doesn't close gently. Markets don't slowly equilibrate. They reprice violently when structural imbalances resolve. The question isn't if it happens. The question is when and how fast. Think about your own positioning. If you hold savings in currency, you face inflation risk. Real inflation, not reported CPI. Currency purchasing power declines over time. That's a certainty. The question is how fast. Hard assets provide a hedge. Physical silver is a hard asset. It cannot be printed. It cannot be diluted. Supply increases through mining only. And industrial demand is accelerating while mine production stays relatively flat. But there's a difference between paper claims and physical ownership. An ETF gives you price exposure. Physical metal in your possession gives you an asset no one else has claims on. No counterparty risk, no settlement risk, no allocation risk during supply stress. Institutions understand this. That's why they buy allocated positions. That's why they pay for vault storage. That's why they don't rely on unallocated pool accounts or derivative exposure for their core positions. The $7 billion JP Morgan position signals their institutional view. They see something in the next 12 months. They see it clearly enough to commit serious capital. They position themselves before retail awareness, before headlines, before confirmation. You can wait for confirmation. But confirmation comes at higher prices. Confirmation comes when access is constrained. Confirmation comes when the structural opportunity is already in motion. So here's where we are. JP Morgan has $7 billion in silver derivatives. COMEX inventories are declining. Industrial demand is accelerating. Paper claims far exceed physical metal. This isn't a conspiracy theory. This is a market structure. The gap between paper and physical must close. It always does. The question is timing. When institutions are positioning now, they're not waiting for retail confirmation. They're building exposure while it's available. This isn't about perfect timing. You can't time markets precisely. It's about understanding structure, about recognizing when fundamentals and positioning align, about seeing what institutions see before the crowd realizes it. When a position becomes public through a regulatory filing, the signal is out. Other institutions see it. Analysis begins. Positioning follows. The question isn't whether JP Morgan is right. The question is, what do they know about the next 12 months that retail investors don't? If this analysis helped you understand institutional positioning in silver markets, hit the like button and share this with anyone trying to preserve wealth. Subscribe for market structure analysis without the hype. We break down what institutions are doing and why it matters. Drop a comment with your thoughts on JP Morgan's positioning. Do you think this signals a major repricing? Are you positioned in physical or paper? What are you seeing in dealer premiums and availability? And here's something to think about. If they're willing to disclose $7 billion in derivatives, what positions aren't they required to disclose?